Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, for the guest that we have today, we have to talk about what's happening in the AMC space and the mutual fund space, and whether domestic flows will continue to remain resilient, and will the retail investor continue to have the last laugh. Can geopolitics and strong growth become headwinds for equities? Because growth may lead to delayed rate cuts, which might not be something that risk assets might like. And what are the contrarian bets in uncertain markets? That is something that we'll talk to our guest, who believes that bottom-up stock picking is the way to go in the current market scenario. Our guest today is Anand Shah, Head of PMS and AIF Investments at ICICI Prudential AMC. Anand, so good having you. Thanks for taking the time out.
Very good morning, yes.
Very good morning, and great to have you in our studios. Just trying to think, Anand, almost every signpost seems to suggest that the soft landing, which was thought to possibly be engineered, is not quite happening in the same way. Data is strong, rate cut bets getting pushed out. Is all of that negative for equities, or do you think it will be taken in stride?
So I think it's complicated.
It is.
It's a good news, which is not a good news in that sense, or good news is bad news is good news. So to that extent, yes, the rate cut to me gets pushed out, maybe the quantum reduces, but it's a strong economy. So that's a solace. And to me, the genesis of this is that China, which was an exporter of deflation, which allowed everybody to print money and have growth without inflation, I think that's behind us. And to that extent, I think there's an inflation which one have to deal with, and that would need a slowdown. Definitely will need some bit of slowdown in US economy, engineered or otherwise.
But it's not happening.
It's not happening yet, and I think to that extent, there is always, even today, some bit of, chatter of there might be need of another rate hike in US rather than a rate cut. Again, these are all chatters that we are talking about. So you're right. I think, as Fed always says, it will be data dependent. So the current data tells us that it's not yet happening. But there are early signs, and we'll have to see, because the rates are going to eventually push back some bit of real estate and other stuff. We are seeing some bit of slowdown in the commercial real estate for sure. Residential is very strong. So yeah, I mean, we are no experts here, but we are watching that data closely.
But you're an expert on sentiment, and there is a tadka of geopolitics now being added to this specter at the same time, simultaneously. Does that make the case for increased caution or heightened caution on risk assets, both sentiment and valuation-wise, or not quite?
I think it's not been the case in last 3-4 years that people were not cautious. I speak to so many people, and each one of us is confused why the markets are doing so well, right? I think the underlying factor of earnings growth rate is not really talked about as much. There is a stark difference between the Indian economy, India Inc., let me put it this way, pre-2020 and post-2020. If you see, for almost 5 years, pre-2020, while the macro was okay, we were not really worried about what's happening on inflation or interest rates. Currencies were okay, growth was okay, but India Inc. was suffering. You had practically no earnings growth rate for 5 years. That's never happened for a long time. Whereas last 4 years, while it's all marred with various macroeconomic issues, be it COVID, be it Russia, Ukraine leading to inflation, dollar strengthening, more recently Middle East, I think the earnings growth has been very, very strong. And that's why I was telling that, look, last 4 years have been really bottom up. There has been very clear, stark difference between the sectors which performed pre-2020 and post-2020, and that's the way forward.
Okay. Okay, let me make a segue that before we talk about specifics, right? But the segue is that hitherto, the belief has been that let's focus on the domestic inward-facing themes, because India growth is looking strong, global growth is not. And for the better part, it wasn't until the PMI data has started to show some green shoots, if you will. Is it time to start looking at export-oriented themes much more than what you otherwise might have? Chemicals, maybe IT, maybe metals, which are majorly globally exposed as well, because the valuations might also be in your favor and global growth is starting to look okay at the margin?
I think I'll rather look at it that way, that there are segments of the market which get impacted by what happened in China, particularly, and US. These are the two large economies, and we need to be cognizant of that. So while metals, we are not very large exporter of metals, and to that extent, that doesn't make a difference, but the prices are impacted. And to that extent, one needs to be cognizant of what's happening there. But you're right, the domestic will be the big driver. But also, when you're looking at exports growth, we're also looking at import substitution in many of the areas. Look, the entire story of pre-2020 and post-2020 difference is China was an exporter of deflation. For almost a decade, anything and everything you needed would come from China cheap. That's changing. Not in 2020, it was changing for a while. And that is what has been the driver of profits also, especially in manufacturing, manufacturing allied businesses, and corporate banks, state-owned banks and the erstwhile corporate banks. They've all been driving the profits. The consumer-facing businesses are doing well prior to 2020. They're still doing okay. I mean, they're not doing great, but they're not bleeding. And to that extent, overall, a large part of India Inc. is better off post-2020 than pre-2020.
Got it. Okay. The other aspect is flows, and just wanted your sense there. FI flows have largely been absent. We don't quite have a handle on when do they make a strong return, because it also seems to be a factor of what happens to global rate outlook, etc., which is fuzzy right now.
Sure.
So does the domestic inflow continue to stay buoyant to your mind and continue to be the, how do I say, the support at the lower levels that the Indian markets have needed in the last 3-4 years, or can that also change?
Yeah, so the global flows, as you rightly said, would be function of US interest rates, and that's further pushed out, if you ask me. From the domestic flows, I would divide into two parts. One is the large SIP money. Now, this is very, very soothing. These are the set of investors who are also not coming for the short term. They've made up their mind that they don't want to make a sudden entry into the markets. They want to come for the long. I mean, inherently, you would want to believe that SIP investors are coming in for a long term. They're taking baby steps. They're not in a hurry. And to that extent, that's, to me personally, very, very soothing, sustainable, long-term commitment to the Indian equity markets at a bottom end of the pyramid.
Sure, yeah.
Want to. The other set of money, which is lump sum, which is HNI money, which would move with the sentiments. To me, it's been more or less neutral. I don't think we would have had, at least from the AMC point of view, from the mutual fund industry point of view, I think the big driver has been SIP. If you look at the net collections, net of SIP, it's not been consistent and great as such.
Right. Okay. Okay. And so, what's the takeaway then, therefore? Because is this investor the smart investor who's putting individual money to work, or is this investor? I mean, what is the implication of such a behavior by large pools of money, which is lump sum in nature?
So again, as I was saying, last 4 years, there's never been somebody who would not be confused with the market. Look, in the backdrop of what's happening in the economy, the market's been doing fairly well, and to that extent, people are skeptical, and rightly so. Many of us would also would question pockets of the market which are frothy. So to that extent, there is, as you rightly said, there is money available when the market dips. I think that's been a consistent factor. We have a large set of investors who would have liquidity, but they're sitting on the fence and saying, look, markets is too frothy, and I would rather wait for markets to correct. So that is one set of money which is still lying. There's other set of money along with SIP is also people are doing systematic deployment of capital as and when there is flattish market, correction markets, or so and so forth.
Well, one of the talking points at the start of every earnings season is IT because of the earnings. This time around in today's session, it's not just because of earnings, but because of a spate of resignations that we're seeing in one large IT firm, that stock is the top loser on the index on Tuesday. My colleague Rucha Somaya joins in to talk about what's happening at LTIMindtree. Rucha, good morning.
Thanks, Niraj. So, as you rightly stated, LTIMindtree is the top IT loser in today's trade. This comes as the resignation count touches to 8 people at the managerial level post the merger. Most recently, 2 members from the global sales team, namely Mr. Chugh and Mr. Dietrich, resigned from their posts. Both of them were working at LTI just before the merger. Looking at the history of the managerial level resignations, I would like to highlight 2 major resignations that were working at Mindtree just before the merger. Number 1, Mr. Vineet Teradesai, who was the CFO of LTIMindtree, resigned just a month back. He was working as the CFO of the erstwhile Mindtree just before the merger. And number 2, Mr. Venugopal Lambu, who also resigned just a month after the merger. He was the whole-time director and the president of markets too at LTIMindtree.
Okay, Rucha, thanks for filling us in. And a spate of resignations pulling out the stock of LTIMindtree lower. Anand, information technology, when you look at what's happening, some churn here and there, AI bringing out this uncertainty around the business that might be there, though IT companies seem to believe that they'll still play a vital part here in the transmission, if not the product development. But the discretionary spending in the US, there seems to be still lack of clarity there. One of the companies mentioned that there might be lack of clarity on the clients till the elections are done. Now, what do you do with IT?
So I think the businesses are great. They've been generating a lot of free cash flow, and not today, for last many years. Incrementally, they're also distributing that sort of profits back to the investors. I think the direction is right in terms of the challenge is growth, and that challenge came about because the valuations at which they are trading today, they need growth. So I think that's what has changed. You had a very fabulous 2 years when the world was in lockdown or in social distancing, and to that extent, corporates had extra money to spend on IT. I think that's pulling back. So to that extent, the investors will have to realign or get adjusted to the new growth rates, which will be much lower than what we saw in those 2 years. And that's the adjustment which I think the sector is going through for last 18 odd months, I think maybe another 12 months, but that's the adjustment we are looking for, that valuations have to be more in alignment with what growth this sector can do.
So currently the valuations don't make it a compelling buy, looking at the mix of growth versus valuations. Am I?
Yeah, I think as you rightly said, we are still confused. What's the new growth for this sector? Given that we still, the US economy is very strong. I can't say that, look, we have already reached the bottom. So I think if there's going to be requirement of a more slowdown, lower inflation in US, then I think we need to see much more slowdown before we see the uptick.
Okay. That's fair call. Okay. And now I heard you say that that the approach has to be a lot more bottom up in a market scenario like this. Now, I know we can't talk stocks and we don't want to, but just trying to get a leaf of wherever you may have taken your large bottom up bets, what are those themes and where is it that you find favor from an earnings growth perspective or a valuation perspective or both?
I think the key is inflation. I think we've been overweight manufacturing and then the businesses which sort of support manufacturing growth, because as I was saying, the key difference between the 2 eras of pre-2020, post-2020 is that world will need to manufacture more outside China. China would not be the factory for the world or would not be allowed, let me put it this way, because each government also wants to protect whatever of manufacturing is left, also develop new manufacturing. So I think that's the one area where we've been focused on for last 3 years. Valuations were very attractive at that point of time, given that almost for a decade that was a sector which was struggling. They have deleveraged, the balance sheets are improving. I think both banks and India Inc. is ready to do the next round of growth, next round of capex, given that they have deleveraged and banks have also been sitting on a very fabulous asset quality as we speak today. So I think that's one area. We believe both infrastructure and the private sector corporate capex, I think both should be a good medium to long-term story as we speak. given that the capacity to relations are reaching a point, plus China plus one can lead to select export opportunities also. I'm not saying across the board, but in select areas where we actually are good, we are globally competitive, we can do manufacturing exports also.
Okay, so not necessarily just the companies which are doing capex, but the ones which might be aiding the capex. So it could be commodities, it could be cement, it could be wire companies, what have you.
And capital goods, power. Power is a very big, I would say, lubricant for the economy in general.
Yeah.
So if the manufacturing were to pick up, and today we are talking of the growth in electricity demand even in US, so obviously India would see much more. Then I think the entire power value chain needs to be prepared to do the capex as the industry takes off, as manufacturing takes off in this country.
Got it. Anand, can you spend a little bit of time on this power? For the longest time, it was shunned, right? Valuations were not there. I mean, people believed that kya hi ho jayega isme. Suddenly, there in the last 12 months, 18 months, 24 months, there has been a recognition of the importance. There has been valuation multiples assigned, and there is earnings growth that is following across the chain. Conventional power, new power, suppliers, distributors, what have you, financiers. So there has been some gains that have happened. Is this a multi-year theme? Are you still constructive here? And therefore, if so, within this whole ecosystem, what is the first amongst equals? What is the favorite?
So there's no denying that the power, we after a long time, we have reached a point where now we are worrying about power deficits, right? Plus, there is a change in the structure. So if you have more solar power, we have ample power during the daylight, but then you have pockets of a couple of hours in a day when we will be deficit. So those needs a lot of investment in grids also, a lot of investment for around-the-clock renewable. So there are various opportunities across the board. I think we are going very bottom up. To be very honest, there are opportunities across the board. At the same time, as you rightly said, it's not a theme which is now undiscovered. It was a theme undiscovered 24 months back, 36 months back, when actually nobody was looking at it. But I think we have reached a point where India will need to do capex for power. Deficit is for real. We are also talking of which was shunned, which is a thermal-based power plant. So that's something which is coming back on the drawing board that, look, while we will invest in renewables, we'll also need to invest in thermal. So I think it's more bottom-up, power generation, T&D, everywhere we are seeing investments happening.
Okay, and you would be constructive across the value chain depending on the valuations?
Yes.
Okay. Final set of questions. I heard you say that power is no longer as undiscovered. It was probably a new theme 24 months, 36 months back. What is it that is, to your mind, a relatively undiscovered theme right now, which to your mind the market will take cognizance of maybe 12, 24, 36 months out?
To me, I think we are all, when we're looking at manufacturing, we are still looking at the new age manufacturing. We are looking at electronics, we are looking at some bit of solar and modules. Right? Yes, that is there. The high-tech manufacturing, EV manufacturing is something which is, of course, we will have to get it right, and we are giving a lot of PLI support. I think the low-hanging fruit is the old economy manufacturing, which you already know. I think that is the one area of manufacturing where China, given the labor is getting expensive, their pollution costs are going up, they would be letting go of many of these old economy manufacturing, and that's where we even find value today. So be it commodity chemicals, be it metals, be it textiles, these are the areas where it's not that it's new to us, we know that, and we can actually scale up very rapidly. Whereas the areas in electronics and all that will need a learning curve. So that's also great, but across the value chain of manufacturing, we believe the low-hanging fruit is in more the old economy manufacturing. Which
the market is not taking cognizance right now, but you believe earnings growth will follow in the years to come?
Yes, that's what I'm saying. And to be very honest, they've not done great. Even in the last few years, it's not that metals have been a blowout performer or something like that. So there's always skepticism that, China can always come back with the capacity and always can dump. I think that's something which will take time for people, because people have scars of the yesterday. Yes. Every time you do little well, and then China will dump a lot of those stuff.
So why do you think this time will be different? Sorry,
that's why I'm saying that's a structural change. I'm saying not only in India, not only that the government would want to protect this manufacturing. But even in China, as they become more prosperous, their ability to manufacture this and dump in the rest of the world and their willingness, both are questioned.
Okay. Interesting thoughts. Anand, it's first time having you in our studios, but I must say it was lovely talking to you, and I look forward to have you more often here.
Thank you so much for having me.
The pleasure was entirely ours, and viewers, thanks for tuning into this edition of The Talking Point.